Peter Eliades with you, Stock Market Cycles Update from Monday, March 23rd of the year 2020. What a spectacular, unprecedented month and a few days this has been. Completely unprecedented in the annals of United States securities history. I mean, it really is, without exaggeration. We have never seen anything like this. Could we have predicted this a month and several days ago? Probably not. I don't know anyone who could have predicted this great a decline in this short a period of time. I mean, the market's basically given up 1/3 of its value in a month from an all-time high. That's never happened before, never anything like that. So what does that mean for now? Big deal. That's history, Eliades. What are you telling us about now? Well, I made a few remarkable discoveries over the weekend. I have been dealing with this price projection theory for a long time now. It goes back to James Hurst, who did the original cycle work. And I've attempted to have cycle projection software written for me before. I'm not a programmer. And it was done to limited degrees of success. I have a gentleman now, Stephen Sherman, who's doing a fabulous job in programming this software. It's pretty simplistic software to begin with. You start with a price up here and you say, okay, it crossed the lines around here, so where is it supposed to go? And the degree of success of these projections is remarkable. But what I discovered over the weekend was the longest practical and orthodox offsets have been on a weekly chart 100 to 110 weeks, which is the 2-year offset for a nominal 4-year projection. Now, I knew there were longer cycles in the market, and I experimented from time to time with longer offsets. But I'm looking at the price history, and in looking at it over the past weekend, I noticed some remarkable things. And that is, if you double that 2-year offset of 100 to 110 weeks and make it 200 to 220 weeks, some of the projections have been spectacular. For example, let's show you something. Let's go back to the 2000 to 2007 decline. Look at this. Okay. Two things here. 2007 high, 2009 low. Well, look at this. This projected the 2007 high. This was a shorter term right here. This green rectangle here was the 100-week offset. This is the 200 to 220-week offset. Look where the high was in 2007, right inside that projection window. And equally, if not more importantly, look at the decline. This was a decline that was given to you by the 100 to 110-week offset, nominal 4-year projection. But look at the next longer one. Wow. Here you go. Here's the 2009 bottom. Here's the projection box right here. From this high, 1576.09, crossing, the higher crossing occurring here, the lower one here. Here's the projection box here. And it gives you a projection calling for between, go down a little lower, 563.67 to 787.01, and the actual low came in at a final low of 666.79, almost exactly at the midpoint of this projection. Okay, and equally as importantly, look what happened back here. So let's go back a little further and see if we can find out anything of interest. I mean, this is a good downside projection right here. This low held for, this occurred in the low of 2001. This was the 9/11 low in the market in 2001, from which point we had a rally for, 6 months or so before we finally came down to a final low down there. Going back further, well, we're not going to do that now. We don't have all the time to do that. Just wanted to show you where we stand in terms of this incredibly accurate projection for what you might call nominal 8-year projections instead of nominal 4-year projections. But look look at this now. Watch this. The S&P has come into the rectangle of its nominal 4-year projection, to the upper end of the rectangle of the nominal 4-year projection. What would happen if it gets down to the lower end of its nominal 4-year projection? I mean, what would happen at that point is almost unspeakable. I mean, I don't know if you want to hear about it, because that would mean if you cross both of these offset lines, remember this is a 200 to 100, 220-week offset lines, if you cross both of those lines and get down into here somewhere, you're talking about spectacularly lower projections, crossing around the 2,300 level from a 3,400 high, 23, that's 1,100 points. Now you're talking about going down to probably somewhere around the 2009 lows. So I wanted to give you a feel of that and what's going on and what the possibilities are. So that's what we're looking at. Now, some of you have asked, what about the New York Composite? Let's put that on these same groups of offsets and take a look at them. So we do a $ NYA.X, and this is what we come up with. Magic of this software. Fabulous, fabulous software. Hope you're excited about it. Look at this. Now this is something else again. I can't tell you that this is going to be accurate, but I can tell you, remember I told you last week that the New York Composite Index seemed to have met all downside projections already. And if that were the case, then we couldn't make an argument for the New York Stock Exchange Index, which is all the stocks on the New York Stock Exchange, for any lower projections. But look at this. Look at this, folks. Where we are today would be below all the different distances between a 200 and a 220-week offset. And let's bring this scale way down. And now look at what you're looking at. 67.80. And that's just using this first crossing. If we use the lowest crossing between the two, it would be significantly lower. And if we close down here this week with a median, a midpoint of the high and low at this point or lower, then you're going to get a significantly lower projection on the New York Composite Index. So I'm giving you this as an idea as to what's going on in this market, and it's not pretty, and it's ugly, and it could be painful for a lot of people, but I want you to know what is happening. Now, quick technical comment. The 10-day moving average of the trading index today closed at a level that was lower than the 10-day moving average. In other words, more overbought than the 10-day moving average at the day of the all-time high in the S&P on February 19th. Does that mean anything? I can't promise you that it does, but it sure scares the hell out of me in terms of what the potential is in this market to the downside. Now, all that having been said, we can make some strong technical cases for some kind of important rally from these levels. The number of 52-week lows has dried up pretty dramatically coming into the low today. We made a new closing low on the Dow and the S&P, and there were 805 new 52-week lows as opposed to 2,233 on March 18th. So there are technical signs that we are in a position to do some kind of a rally, perhaps a dramatic one from here. But these are the things that we look at. We don't look at the technical indicators that 99% of the technicians look at and say, well, look at this and look at this back here and this back here. We look at the actual prices and what they tell us. And what they're telling us now is potentially a not very pretty story. We're going to keep following up with you on these charts. Just want to make you aware of what's going on both internally and externally, price-wise, in the stock market. That's it for now. Thank you so much for watching. Give us your comments. Subscribe, bottom right of the screen in the little red banner if you haven't done so yet. And if you do that and you put in your email, once you click on the bell after you subscribe, you should be notified of all the updates that we do, whether they're regular or special ones. Thanks for watching. We'll talk to you tomorrow.